Hello everybody and welcome to another one of IRONSHIELD Financial Planning's Fly on the Wall webinars. For those of you who don't know me, my name is Scott Plaskett. I'm a certified financial planner and the senior financial planner and CEO of the fee-based financial planning firm IRONSHIELD Financial Planning. If this is your first time tuning into a Fly on the Wall recording, let me quickly explain to you what this is. You're going to experience what it's like to be a fly on the wall during one of my update calls with a member of our Top Guns network. This network is my personal network of specialists. Every so often I ask a member of my network to touch base with me to bring me up to speed on the latest happenings in their area. And when they call me, I record the call so you can be a fly on the wall for that call. On today's episode, I invited Mike Flux, Senior Vice President and Portfolio Manager at Connor Clark & Lund Private Capital, to chat about their investment outlook. We also discussed how to interpret the current events and how to properly position portfolios to take advantage of these market events. He shares a very well thought out and disciplined approach to investing in today's environment. Now, here's the call. All right, Mike, Ryan, I want to thank you guys for taking the time today to go through and give me an update on what's happening or what's happened in the third quarter, and then maybe shed some light on sort of what your crystal ball is saying for the fourth quarter, because there's some interesting things that are on the horizon in the fourth quarter, that's for sure. But some really quite interesting things took place in the third quarter. So, yeah, why don't we just hop right onto it and we can chat about what went on in the third quarter of 2016.
That sounds good, Scott. And just as a reminder, another reintroduction, Ryan McNerney joined us the last time, and his name's on the front page, and he's with us as well. So maybe Ryan can say a quick hello.
Yeah, hi everyone. Hi Scott. Pleasure to be on the call again.
And not to get too legal on you, but I just wanted to point everybody's attention to the disclaimer at the bottom that this presentation is made for informational purposes only, and the views expressed are the views of the speaker. Namely, Ryan and I will probably share some personal views along with some views that would be shared by Connor Clark & Lund and our affiliates. But I just want to point this out before we get too far into this here. As always, what I'm going to cover off is some performance highlights from last year. Get you caught up on quarter three and what's happening this year. Talk about some of the economic factors driving markets all around the world. Focusing on investment market themes and our outlook. Everybody wants to know our crystal ball, so we always tend to share that. And then talk a little bit about what that means for you in terms of how the portfolios are positioned. Of course, we'll talk about the alternative investments as well, but we'll cover that in a separate call, as we've done in the past. Quick reminder, 2015, we covered this off the last time, but just a quick reminder to see how the world can change. Global equities did extremely well last year, up around 20%, a lot of that from currency. Canada did not do well, down around 8%, including dividends, over 10% to the negative if you're just looking at the price index. But there was a lot of volatility last year around Greece back in June was a concern. China was a concern. There was a global market pullback in last August, September. There was another one at the beginning of this year, January, February. Then we had the Brexit vote in June, and now people are concerned about the Trump election. So there's been a lot of excitement and volatility in the markets, I'd say, but overall, if you were invested in a diversified way, you can see how well you would have done, in particular outside of Canada. Our global equities all did very well. We were about 6% overweight global equities last year, which was good. Global small companies, one of the components of our portfolio was up around 27%, so that was good. We were 3% underweight Canada, which was also good because Canada generally did not do well as well as the global markets. But you can see how each of our Canadian mandates did better than the TSX, and some by quite a margin. So we're quite proud about how last year worked out in the stock side of things. Bonds did pretty well as well here, up 3.8 relative to the market at 3.5. High yield bonds struggled a little bit last year, but I'll point out that high yield bonds have had a nice recovery this year. And then the alternative investments last year, quite a phenomenal year, up 22 in infrastructure, up over 9 in real estate, up around 17% in multi-strategy. So certainly there's some good value added there. Quarter three, this is what we love to show people as much as possible. You can see everything is up. Bonds are up another 1.2%, which is really quite outstanding when you look at the 10-year Canadian government only paying around 1% so far, or sorry, at this point. So just in the 3-month time frame of quarter three, we're up 1.2. For the year, Canadian bonds for the markets are up 5.3. U.S. is now positive for the year at 2%. Had a really strong quarter three at 5.1. Canada up another 5.5 for the quarter, almost 16% for the year to the end of September. And surprisingly, international equities, which would include the Eurozone and the UK, up 7.8% following the Brexit vote in late June. They're still down 3.3 for the year because there still is concerns about how the Eurozone will fare as this all unfolds. But quite a phenomenal recovery after the sell-off that happened in late June. Now here's some of the specific numbers for Connor, Clark, and Lund versus the markets. Some pretty solid numbers here out of high-yield bonds for the quarter. For the year, up 7.9%. Canadian stocks all did really quite well for the quarter here. One portfolio, actually our dividend portfolio, underperformed, even though it's one of our better performers over the last 5 to 10 years. You can see for the year some pretty phenomenal numbers here, in particular from small companies that really had a standout performance year so far. Global equities had a very positive quarter. We did pretty well on a relative basis as well there. And you can see the results for the year, not as strong as Canada. And then you got real estate up 4.5 for the year, only 6-month numbers. Infrastructure up almost 7, and multi-strategy up 1.4. Had a pretty good quarter 3, up 1.7%, but falling a little short of where we'd like that portfolio to be for the year. For the year, remember that other chart I showed you where global equities were up 20% last year, and the TSX was down about 8. Well, for this year, it's kind of working reverse. TSX up 15.8%, international equities down 3.3%, U.S. equities a low single-digit rate of return after 9 months, all in Canadian terms, but not exactly what we're looking for. Bonds, on the other hand, had a pretty solid year, up 5.3%. People often like to look at the global chart in terms of what's happening around the world, and here you can see Canada, certainly one of the dominant places. This is pretty ironic. UK in local currency terms up 14%. So clearly the market's responding quite positively related to the Brexit vote, given UK is up, and you can see some other countries in the Eurozone that are not faring as well. Here's our famous ledger as to what worked and what didn't for the year, and this really hasn't changed at all since the last quarter. Bonds have been really solid for us. Short-term bonds not as much, but they're more conservative, which is why they've underperformed the general bond market. Canadian value stocks have done very well. Canadian growth stocks haven't done as well this year, so it shows you why you need different styles, because different things perform at different times. But Canadian equities in general have all been nicely positive, so it's been a good, solid, absolute return contributor. Canadian small caps have had a really solid year. I showed you the numbers, up over 27% to the end of September. Global large companies, on the other hand, have not been as strong. Global small companies have done very well. Real estate and infrastructure alternatives have done quite well this year. Multi-strategy, on the other hand, has had a bit of a weaker year after several years of significant performance, where it's added huge value.
You know, one thing I just want to just touch on here. I mean, I've been quite impressed with the fact that the Canadian equities, the value side, have done so well, and pleasantly surprised, to be honest with you, because if you'd asked me 12 months ago, you know, where did we see the Canadian side being, I wouldn't have predicted this level of performance. What really, I mean, was there a component to Canada that generated this, or what was it specifically that was causing this?
Now, for this year, here's the numbers that we're talking about. TSX up 15.8. There's all our portfolios up in and around the same or better. But the small cap will really draw your attention to this. I mean, mining and energy got killed last year, as did the Canadian dollar. So all metals kind of went down in value. Energy went down to $28 a barrel. Well, we've seen that turn around to closer to $50 today. It's been volatile, moving up and down between the low 40s and 50, or a little bit over 50. But we're trading at a relative high point right now for energy. So that certainly helped Canada a lot. Also, our exchange rate moved it went down to 68 cents. Now it's back up into the higher 70s. So we've seen a really solid bounce back in that regard. All of these numbers, remember, in the global side are in Canadian dollar terms. So if the Canadian dollar is going to appreciate relative to the US dollar or the euro, that's going to affect the returns, which is one of the drivers of some of these negative numbers. So it's really just whatever went down the most last year went up the most this year.
Right. But what you're saying is, I think, a very good point, that just there's a lot of volatility.
There's been a lot of volatility, and Canada really has been beaten up on a relative basis, despite our economy being in reasonable shape over the last several years. And so, a lot of this is just, the market bouncing back, reverting to the mean, if you will, to make up for the minus 10% numbers last year. Global equities were up 20.
Sure.
So, it's not often you see a 30% divergence in returns between Canada and the rest of the world.
Yeah, no, absolutely.
So we kind of covered the numbers here. We're not completely pleased with the global equities this year. Fortunately, we reduced our global equity exposure. We were 60% overweight last year and 3% underweight Canadian equities. Well, at the beginning of this year, we moved to a more neutral stance, more equal between the two, which helped because Canada has done a whole lot better. Bonds looking very solid for the year, up 5.7. High yield bonds up 7.9. And again, remember, these are 9-month numbers. We still got time before the end of the year. All the alternative investments okay, certainly quite attractive out of real estate and infrastructure, a little bit weaker on the multi-strategy side. So a few things we just wanted to show to address the recent performance. Our global equity team tends to focus on return on invested capital as a metric. And what this shows you is just one stat. If you look at the S&P 500 from 95 to 2016, you can see what the S&P 500 has done, but you can see what high U.S. return on invested capital stocks have done. They've done a whole lot better over that time frame. We're looking at almost a 50% outperformance on the levels here. This year, however, return on invested capital style has been out of favor. And so our U.S. and our international teams and our global teams have underperformed a little bit in the short term, but we certainly feel that these managers have added value over time, and we think that style will come back in favor. So we're going to stick to our knitting, and we hope and expect that we'll see better numbers down the road on the global side. Multi-strategy. I shared some numbers from last year where it was up 17%. Well, the year before it was up 25%. This portfolio has averaged north of 9% gross of before fees. The objective for the portfolio has been 6 to 8, but even if we just say 5.5% is our return objective, compared to core bonds, which are probably at best going to do 2% in the next 10 years, we think this is a solid portfolio to have as part of the overall portfolio, because it'll help us to manage the fixed income and the interest rate risk that we see coming in the marketplace. Having said that, there's a lot of times that this portfolio outperforms, very few times where it's underperformed bonds. But this year's one period of time where it has underperformed bonds by a little bit. Q3 it's outperformed, but moving forward we would expect it to outperform bonds. In particular, with Government of Canada is only paying 1% over 10 years right now. So unless there's questions, let's cover some of the economic factors. I'm going to preempt one of the biggest questions we've been getting lately around the Trump election. Everybody seems to want to know what happens if Trump gets in. Is it going to be Armageddon? Should we be in cash? Similar to Brexit, we don't see this as something where you should move to the sidelines. If you're sitting in cash, that's one thing. Maybe you don't have to be quick to jump in. Maybe put some in, take advantage of recent volatility, stage some in over the next 2 to 3 months, maybe to take advantage of ups and downs. But if there's an emotional reaction to who gets elected as president, usually that will lead to an investment opportunity, because the markets will way overcorrect based on the emotion, and people can lean in and take advantage of the market starting to make sense again over time. If you just look at the fundamentals between Trump and Clinton, there's obviously they stand for different things around tax reform, infrastructure spending, defense, global trade, immigration, energy and energy policy. But there's certainly some sectors that will be favored if Trump gets in, and some sectors that would favor Clinton as president. So depending on who we think is going to get in, it might impact how we make decisions around what sectors to be in. If Clinton gets in, energy is probably not looking as good. She's quite anti-energy. But for Trump, he's obviously for it. From an infrastructure standpoint, it's interesting because we do have an infrastructure portfolio that focuses more on Canada, but if both are pro-infrastructure spending, so that's a bet we can make today and feel pretty comfortable with. If Trump gets in, it's just 3 times as good, because he's planning to spend 3 times as much as Clinton is. So this just shows that, who gets in as president shouldn't drive whether you're in cash, bonds, or stocks. It should be more about which sectors are you going to be in based on who's going to get elected. I'm sure there'll be a lot more questions on this, and so if anybody wants to talk about our thoughts on this in greater detail, by all means, reach out to Scott, and we can have some one-on-one dialogue.
Yeah, what I find is interesting, and this is the first time I've seen a slide actually like this that actually speaks to. I mean, it's not making a prediction as to who you feel is going to be the winner. That's not what this is about at all. But it is very interesting to see how you've identified who, based on their platform, what sectors will be affected in what way, which, leads to very disciplined investment making decisions where you can, lean the portfolio and take advantage of certain areas as a result of opportunities that present themselves. But it's important to point that we're not necessarily making a prediction as to who you feel is going to be the winner, but there are certain areas to take advantage of as a result of the winner being announced.
And I think this call is being recorded, right, Scott? So you'll never hear me express my political views on a recording. But if anybody's interested, by all means, let's have a chat, and happy to have that discussion. But we're trying to keep this very balanced around, how this should actually drive stock market and portfolio decisions, not just from an emotional standpoint, which seems to be driving the markets more than not these days.
Yeah, excellent.
So here's some hard stats. What we're looking at here is the top 1% of U.S. population and the bottom 90% in terms of income earners. And what's interesting to see, the family real income of the top 1% has been growing quite tremendously from the 1920s all the way through to current times. But what's equally or oppositely interesting to see is that since 1970, we've seen the average income of the bottom 90% of income earners flatten out a little bit. And here, these numbers are like about 1.5 million would be, what the average top 1% is making in the U.S. The bottom 90%, it's around 35,000. So, 2/3 of the economy is the consumer, and so you want to track these kind of things. When the general population has not seen significant growth, that's something that is a little bit of cause for concern. We can't just rely on the top 1% to drive the economy. Economic growth, we think it's going to be a little bit lower for longer here. GDP growth is kind of lower single digits right around the world. China would be growing at more like 5 to 6% or more. This is one measure that we like to look at, which is Purchasing Managers Index. It's a leading economic indicator, and what you want to see there is a number of 50 or greater, but the higher above 50, the better. So what we're seeing is, most nations are growing and the economy is moving forward, but it's still in a very low growth phase. We're not seeing anything up here in the high growth phase in the 55 to 60 range. We're only seeing one country that's slightly below 50, and that's Australia. Some countries are strengthening in this regard. Some are weakening, and so it's kind of a mixed bag around, will the global economy grow or not? The Eurozone is a bit of a wild card here, and we're waiting to see how that unfolds. If the Eurozone can dip into the strengthening category, then we're looking at a pretty solid circumstance where the global economy is generally growing, and that's what we want to see. But a lot of things need to be figured out related to Brexit and how other countries, like Italy as an example, might respond to this. One big prediction that everybody's looking for us to make is, will the U.S. Fed raise interest rates in December, and how much will they raise over time? Well, there's three things that they've stated that they're looking for. They want solid economic growth. Right now, the economy is growing around 2.1% in the U.S., and the average long-term is 2.8. So, is this solid? Maybe in this market environment, it's solid relative to the rest of the world, but certainly not to the long-term averages that the U.S. has experienced. They want to see strengthening labor. Well, we've seen unemployment drop from 10% back in October 2009 down to less than half of that in August of 2016. We've also seen wages growing here a little bit, which is a positive thing. They also stated they want to see core inflation back to 2. Well, it's at 2.3. So, two of the measures were certainly looking pretty solid. This one, it's a matter of interpretation, but time will tell if the U.S. starts to raise rates. But if it's not in December, we think it'll happen soon. and then there'll be a slow and measured period of time where interest rates might start to go up as opposed to going down, which is what we've seen recently. And if that happens, Canada is likely to follow suit at some point here. So we do need to get ready for a rising interest rate environment, whether it be now, this year, or sometime next year. Some other U.S. stats, job data is really pointing to improving consumer outlook. You can see the positive trend here. However, on the other side, investment spending has been in decline. It's still positive, but it's certainly trended off a little bit. And when I say investment spending, we're talking about more business investment. Consumers are strong. That's 2/3 of GDP. The other 1/3 is the business community, and that's been in decline. Eurozone, there's certainly been economic growth. We're back into positive territory following some of these slumps that we saw, but it's still quite low growth. Inflation's pretty low, tracking at around 1% and tracking sideways. Canada, there's a little bit of negative news recently about employment growth, kind of moving up and down, some volatility. Lately it's been trending up again, but certainly nowhere near as strong as we were back here in 2014, 2015. Banks are tightening lending standards, and when they tighten, that does tend to slow down the economy a little bit. You'd rather see them easing, throwing money into the market to fuel the market growth, but right now we've seen a bit of a trend of tightening. China, a bit of a mixed picture. We're seeing consumption from the average, from the just average consumer in China growing. You can see 3.7, 3.7, 4.2, 4.9. But other areas like business investment has been in decline. Net exports have been down. But it's nice to see the consumer stepping up. So as opposed to being an exporting nation, it's going to be generated. Their success will be generated a little bit more domestically. Let's turn to the investment market themes and our outlook moving forward. I mean, this is a pretty happy chart to look at, actually, because if you look at quarter four, we had a really solid quarter four last year in the markets. This is a mix of the TSX, 45 TSX, 55% rest of the world. But quarter four was quite a strong recovery following a couple weak quarters in quarter two, quarter three last year. Quarter one did not start off well with a 10% pullback in the markets. You can see what happened here. This global market correction bottomed out in February 11th of the quarter. But since then, there's been a nice recovery. It didn't really weaken until Brexit. And then we had Bank of England cut interest rates. That helped to fuel some growth in the UK. There's some talk about a rate hike in the US, and that caused a bit of a sell-off. Ultimately, the Fed decided to hold, so then the markets recovered a little bit. So seeing 3 out of 4 quarters that are positive is actually a pretty good picture. Typically, 2/3 of the time the market's up, and 1/3 of the time the market's down. But overall, the one-year picture not looking that bad. But at the end of June, if people remember their statements, the one quarter that was what happened before this was quite a big negative in quarter three. So we actually had 2 pretty big negative quarters back-to-back with 2 global market corrections inside that one-year time frame. And then Brexit happened right at the end just to tilt the markets down. So it wasn't exactly a good one-year picture. Just 3 months later, you lose one bad quarter, add one good quarter, and people are looking at, if you're looking at your statements, you're looking at some pretty positive numbers on a one-year basis. So we're all happy to see that, I take it. In terms of earnings, we've seen some pretty steady earnings growth here out of the U.S. China obviously had a bit of a dip, now a bit of a recovery. The rest of the international markets down, but with a bit of an uptick. Canada, a bit of a downward slide here. But, you know, we do think equity earnings are going to improve, but on the other hand, valuations are somewhat inflated. I mean, in Canada, you can see here's the current priced earnings multiples that you're paying, and the green line is the long-term historical average. So we're slightly above average here in Canada, US, and the emerging markets. We're slightly below average in the international side, which might mean that there's a bit of an opportunity to buy in at reasonable valuations in the international markets. Maybe some of these recent sell-offs have been overdone. Oil price, you know, we can see what happened here. It went from about $110 in 2014, slid all the way down to $28. We're now back up into the higher $40 range, you know, trending at around $45 to $50. most days. We saw a negative trend around active rigs declining, but now we're starting to see a pickup there. We're seeing inventories start to come down again a little bit. So, that's a lot of what's driven the price of oil back up from $28 up to say around 48.
And do you feel that is that more of a happier zone for oil to be trading in, or are we just still, faced with the potential of a lot more volatility in that area?
Well, I'd say the energy companies would say it's about $20 better than 28. So, I mean, at 28, it would have been dismal. 48 is not ideal. We do think oil will probably creep up over $50 and trend up to 50, 60 over time. But 48 is certainly a lot healthier than 28, and that's why we've seen energy companies having such a solid year this year.
Sure.
Now the dollar went through a similar decline. You can see where we were just a short while back here. We're down in the 76 cent range, and it's moving up and down. The long-term average is 82 now, so we're below average. I wouldn't say we're undervalued, but we're certainly not overvalued either. But if you look at the key factors that drive what favors Canada versus the U.S. dollar, more things are favoring the U.S. dollar versus the Canadian dollar. And purchasing price parity is one thing we look at. That's kind of neutral. But in general, these statistics would favor the U.S. dollar. But at the end of the day, a lot of what drives this is the price of oil. Oil went from 28 to 48. The exchange rate went from 68 cents up to closer to 78 cents. So there's a very high correlation between oil and the exchange rate. Some statistics on bonds. Everybody's historically held bonds for income, stability, and diversification. The government of Canada has been kind enough to lower their rates down to 1% recently. So you tell me if you think that's a good decision to lock in for 10 years at 1%. Certainly, we don't think that's the place for money long term. So we're looking for alternative investments, ways that we can diversify away from traditional fixed income. Look at provincial bonds, corporate bonds, for opportunities to buy them for the higher yields that they can get. Because if interest rates do go up, even 1%, you can see what will happen to the returns of bonds. And these are some statistics from 2000 when yields were way higher than they are today. But what happened in 2005, 2010, 2016, when interest rates rise, government bonds drop in value. And people don't really think of bonds as something that can or should drop, but quite frankly, interest rates can drive returns up or down in that space. So it's something it's a risk you got to manage.
And I think this is the one area that if you ask any portfolio manager, where's one of the biggest challenges in your overall portfolio today, because people are running balanced portfolios, they're always going to have a certain component in this fixed income category. And I think this is probably one of the biggest headwinds that a portfolio is going to face going forward. I mean, it all depends on where we feel interest rates are going to be over the next decade, and whether or not they're going to be that much higher, or But I think there's a strong argument that says I don't know how much higher they're going to be. They're just probably going to be higher than they are today. And with that headwind in front of you, it just makes it much more challenging. So. The traditional approach where you just go and read a textbook or read a book from the library that says, well, traditionally this is how it's always worked. I think that has to be thrown out right now. I don't feel that we can just follow tradition because we have never been in this environment before.
We echo your views on there. So here's our crystal ball page. What are we going to do about it? Short term, there's been an opportunity in bonds. So, a year ago, you would not have seen core bonds as a neutral to slightly favored asset class for us. Cash has always been in the more unfavored category. But short term, while there's volatility and interest rates could still drop related to that, core bonds have been a decent place for money. Generally, what we like here, and this has been pretty consistent, multi-strategy, infrastructure, and real estate have been in the highly favored category. And it's a way that we can reduce exposure to volatile public market stocks, volatile fixed income that's going to be low return producing, and even stocks. Like, gone are the days where 10+% is going to be easy. We think 7 to 9 would be a positive outcome, but we think volatility has moved up a fair bit. So Thinking outside of the box and incorporating alternative investments makes sense. What we like a lot right now is global small companies and bonds. We're somewhat neutral on large caps in Canada and around the world. High yield has certainly worked out quite well here, but if stocks are going to be volatile, then high yield bonds could be a little bit more volatile as well. Small caps have done very well this year, and we've held some, but we're looking to kind of shift away from that a little bit. We don't think they're going to continue to do as well moving forward. And here you can just see, some of the changes in our overweights and underweights in Canada, global, and bonds. At the beginning of the year, we started off about 6% overweight global equities, shifted it down about 3% overweight, went down to a much more neutral stance. Now we're overweight again. So we're looking for relative opportunity between Canada and the rest of the world and adjusting related to that. So we're always making tactical changes within the portfolio based on what we think will deliver the best risk-adjusted rate of return for clients. Now, one thing that you touched on, Scott, you got to challenge conventional thinking, and we would agree the investment landscape has certainly changed a lot. Back in '95, you could have just a fairly heavy mix of bonds in the portfolio, and only a small amount of equities, and you could do a 7% return with pretty low risk. So fast forward 10 years to 2005, you had to dramatically reduce your bonds, increase your stocks, and even add a little bit of alternatives to get that same 7% return. But look what's happened. Your risk is going up, obviously, because you don't have all your eggs in the bond basket. Now, fast forward another 10 years to 2015. Again, bonds have to come down more. Equities, you want to take equities down a little bit and ramp up your alternatives that much more. So to get the same kind of return, you got to be willing to take on a little bit more risk and even put some money into the private markets where we'd expect returns to be more like 8 to 11% relative to stocks at 7 to 9, bonds at 2 to 4, and the short-term bonds might do less than 2 to 4. So it's something we need to be prepared for. And for clients that want to generate the same kind of returns, we at least have to have the conversation around how we might have to make some adjustments in the portfolio to achieve that. Or we maintain the risk profile, but settle for slightly lower returns in the market that lies ahead. We've seen this chart before. Fortunately, the business continues to grow. We're now over $6 billion, which is great to see. Ryan are two of 36 portfolio managers across the country, working with Canadians in all the major cities and pretty much all small communities. We now got over 2,200 clients, and we're amongst one of the fastest growing private client high net worth money managers in the country. The company as a whole has grown from $10 billion back in 2003 when I started to over $70 billion. We're the biggest independent firm in the country, managing money for Canada Pension, the 6 major banks. So quite happy to see the growth of the organization, which has in part happened because we're willing to invest in the business and bring different ideas to the table and innovating. Recently, I just mentioned becoming a signatory of the UN supported principles of responsible investment. We're always trying to think ahead about what's next. And a quick update, I can't get provide too much detail. We do have another alternative asset class we're looking to launch in the private debt space, where we'd expect returns to be in the 6 to 9% return range or even better, but with a fixed income type risk profile. So yet another way that we can provide some good risk-adjusted rate of returns, manage the fixed income and interest rate risk that we see in today's environment. And we're happy to talk more with any investor that would be happy to explore those opportunities.
And what you've been talking about there, I mean, it's great to see. I mean, it's probably sometimes uncomfortable when you've got to blow your own horn to say, hey, look what we've done and all this sort of thing. But I want to talk to the point. Maybe just go back one slide, because I want to go talk to one point, which is I look at this and I see a toolbox, and with the way the economic environment is going, if you don't have the right tools in your toolbox, if you don't have the ability to bring the right tools into your toolbox, then when you need to go and repair something, or when you need to go and fix something or modify something or adjust it, and you don't have that toolbox full of the correct tools, then you're basically you you could be, stripping the threads. You could be, damaging things because you're trying to use something that maybe isn't appropriate. That maybe is, and I'm thinking in my mind right now of, a plumber, if he doesn't have the right monkey wrench or whatever, and he tries to, reef on something, he could just strip the whole thing, or could just snap the pipe off, and now he's got a bigger problem. And so it's important to make sure that you've always got the ability to turn to a toolbox that can bring in the right tools. Maybe they're not all there right now, but maybe they're not all needed right now. And like you're talking about with another alternative that's being brought to the marketplace, or that you're bringing to the marketplace, it's probably because I would think you recognize that there's a tool that is needed in order to continue generating and developing the returns that are required for clients to accomplish their financial goals. So I just wanted to sort of point that out, because that's what I saw when I saw this chart. It wasn't just a let's beat our chests and show you how good we are. It's really an example of a very leading edge company who is always aware of what's needed for the job.
That's great. Well, I'm glad that I didn't have to toot our horn too much. Thanks for doing it for me.
I just wanted to point that out, because I thought it was important. That was the perspective that I took when I saw that.
Yeah, that's great. And it's one of the reasons I love working at Connor Clark in London, is that we're very innovative. I mean, we were one of the most innovative firms in the market back in 2003 when we didn't have any alternative investments. But then shortly after I joined, we brought multi-strategy to the table, and that's another tool that we could talk about. And continually, we've added other asset classes like global small companies, private market investments in real estate infrastructure, income portfolios, high yield bonds, changing how we approach global equities. We're always trying to think ahead, and this private debt asset class, which is going to be a new introduction for us. We got a solid team that's been in the space for a long time that we're bringing in. That will be the next stage in that evolution. So we're quite excited by it.
Great. Well, listen. Well, it's been we've had a long discussion so far, and I don't want to take it too much longer, because there's a certain attention span that we have to pay attention to. So, but listen, thanks guys for taking the time and going through all that. It was great to sort of get that overview and to see where things have come so far, and where they're expected to go. So I always look forward to getting together for these calls, and we'll look forward to the next one at the end of Q4.
I totally agree with you. I'm getting a little bit tired about hearing myself talk too, so I think we'll call it a day there. And if anybody does want to talk more specifically about any of the slides that we presented, or their own circumstances, obviously just reach out to Scott, and we'll be happy to have that one-on-one chat.
Excellent. Thanks, guys. Thank you for listening to today's call. If you require further information or have a question relating to today's call, please go to the comments section in the show notes below. Ask your question or make your comment, and we'll respond directly online. If you would like to take advantage of a free, no-obligation appointment, please call me at 416-626-6515. Or you can visit us on YouTube by checking out our YouTube channel, youtube.com/IronShieldCFP. Follow me on Twitter, twitter.com/IronShieldCFP. Like us on Facebook, facebook.com/IronShieldCFP. Or you can connect with me on LinkedIn.